Hello and welcome to episode 359 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leake. Now, Damien, before we start off the show, we mentioned it briefly last week, but Money to the Masses has had its 500th podcast episode. How about that?
I know, Andy, it's incredible actually, because it really snuck up on us. I feel like we should celebrate it, or have celebrated or made more of a thing of it than we've really done, because it is quite an achievement to do 500 podcast episodes, especially given that when we started this podcast, we weren't really sure that if it would even work, a podcast talking about money each week. And obviously it's grown over the years since we've been doing it, which I always lose track how many years it is now, 7 or 8 years we've been doing the podcast. So yeah, it's incredible to have done 500 episodes. So thank you to all the listeners who listen to the show each week, feedback, are part of the community. And all I can say is here's to the next 500 episodes.
I hope so, because if we make another 500, that means I'm in employment for at least another few years to come. So that keeps me happy. And I tell you, I'm confident that that's the case, because we've just been so busy, haven't we? And so, Damien, do you want to share what we've been doing this week? Because there's something big happening next week, right?
Yeah, so we're launching Grow It this week. So if you recall, at the beginning of the year, we did a 28-day challenge. And it was only called a 28-day challenge because it was the start of the year. But what we're doing is creating a program to help people take control of their money. So it complements Damien's Money MOT. And the way it's worked, there's 3 phases to it. So there's Own It, which was where people owned their money essentially. So they wrote down what they had. They created that black book that I've talked about in the past on the podcast. And so they could see where they are with their finances. And then they moved on to be able to fix their finances and improve their financial situation. And of course, that then led us to the final stage, which is really Grow It, which is about growing your knowledge of investing and also starting to grow your wealth at the same time. And that covers everything from investing to pensions. So it's a 28-day or 4-week program, and we're going to be covering everything from improving cash returns to ethical investing, including pensions. So you name it, we'll be doing it, and we'll be linking through in the same way, all on Instagram. So the whole thing is run on Instagram. So if you aren't following us on Instagram and you want to take part in the Grow It program, then make sure you follow us, and you can go through and it'll improve your knowledge. It doesn't matter if you're a beginner and you know nothing about investing, or you're somebody who is experienced, because there'll be something on there for everybody. And we cover all areas of investing. So I'm so excited about that. And as a result, in the next couple of weeks, you'll probably hear some almost back to basics type content on investing in this podcast, because we'll use that to complement what's going on in Grow It. So on that, Andy, one of the pieces which I will talk about today is about risk versus volatility. So I want to talk about the difference between them. Now, the other piece on the podcast is a bit of a meatier piece actually, and it's an investment piece, and it's regarding investing ethics and the war that's going on in Europe. So it'd be very easy for me to go and create a piece about investing to benefit from the war, but I don't like that. I think that's very insensitive. So I'm going to do a piece about investing ethics and the war that's going on. And it really looks at ethical investing as a concept as well, and the impact that the war and the current environment we're in is having on ethical investing. And the last piece is a result of a question that was sent in, and it focuses on the taxation regarding becoming a limited company. So that will interest a lot of people listening. And Justin is going to come on to the podcast to do that piece, because Money to the Masses is a limited company. Justin does all of the financial stuff in the background. So it seemed only fitting that he'd come onto the podcast. But obviously for that part of the show, I will disappear, won't I, Andy? Because you will realise, if you've not heard Justin, he's been on the podcast a couple of times in the past. We are identical twins, and we do have voices that sound remarkably the same. It will just become too confusing if I'm on that part of the show as well.
Yeah, absolutely. So that will be coming out towards the end of the podcast. So let's start then, shall we? We're talking about investing, and particularly the invasion or the war that's happening in Ukraine. And you decided to take a deeper look into that. Like you say, it feels a little bit immoral to talk about benefiting from investing in the war, but actually looking at it from the other side, what happens during a war and how does it affect investments?
Yeah, so as you say, I haven't done a piece on how to invest for the war in Ukraine, because there's a part of me that finds that a little bit unethical. It feels a little bit insensitive to do that. But it started to make me think about the question of ethics and war and sticking to your own sort of ethics, essentially, when it comes to investing. And that kind of morphed into looking at ethical investing and what's going on at the moment, the macro backdrop, because there's been some very interesting developments for the whole ethical investing idea and the concept, so things like ESG. Now, there was an interesting piece in the Telegraph this week that was titled BP and Shell's long-standing Kremlin links expose charade of ethical investing. So you can go and find that piece if you want. We will link to it in the show notes if people are interested to read it. But the reason I bring it up, because the author of that piece really was scathing about partly BP and Shell, but the idea about ethical investing as a concept. Now, if you recall, what's happened this week is that BP has vowed to offload their $14 billion stake in Rosneft, which is a state-owned company in Russia. So they are distancing themselves from their involvement in Russian companies, in particular state-owned one, because obviously, if you've been listening to the media, then people are trying to distance themselves from that regime and the potential to be inadvertently funding their war effort. And at the same time, Shell withdrew from a partnership with Gazprom, and that will mean an exit from assets worth about $3 billion. And if you recall, if you listen to the news, Gazprom was the sponsor of the Champions League, and that has obviously been terminated now. And what the piece did was talk about how we got to the point where ethical investing has not excluded companies such as maybe Shell or BP or other companies more widely from the remit that funds invest in. So, for example, BP and Shell might not be in many ethical funds in particular because of what they invest in, but others have been. And you can see there's been a clamour this week of companies trying to distance themselves from Russia. And it raised a very interesting question that the obsession with climate change has led to an oversight politically, where the whole ESG idea or the whole ethical investing idea has seemed to have been focused largely on the impact on climate change, but has overlooked some very important things like what's happening in Russia, and effectively companies that have very close ties with the Russian government. And so the first thing I really want to point out is that it reinforces the point that if you want to invest ethically, then you really need to take charge of your own investments. And that may mean that when you look at funds, you have to drill down and you have to look at what companies they invest in and whether you are happy with them. Because with the whole ethical investing, we've done numerous podcasts that we can link to on the show. We did an ethical investing event, a live event, which we'll also link to. It is a bit of a minefield, ethical investing, and there is no set definition about what is an ethical investment. It's very much a subjective view. So it leads to a situation where you could inadvertently be investing in things that may have been benefiting the Russian government, for example. So that is one thing that it raised the question of in this environment about your own ethics and what you're investing. Maybe we need to be looking at things a little bit more deeply if you are somebody who invests ethically. But what I wanted to move on to was actually ethical investments are underperforming right now. And people might not realize it. And if they look at their portfolios, they might see they are down. But I just want to highlight, again, the inherent biases that exist in ethical investing. But it doesn't mean that it's necessarily a bad thing or you should ditch it. But I just want to be able to explain it so people can understand why they might be underperforming, and then they can make their own decisions and not necessarily chuck the baby out with the bathwater when it comes to their own portfolios. Now, obviously, if you think about it, Russia and Ukraine play a really important role in commodity markets right now. So Ukraine is one of the biggest wheat producers. Russia is one of the biggest oil and gas producers in the world. And so the war has seen commodity prices rally significantly. And that is putting upward inflationary pressures on most economies around the world. And we're all going to start feeling it with our energy prices starting to go up. Now, usually in an environment where inflation is soaring, then that is pretty bad for things like tech companies, because it usually means that central banks will raise interest rates to tackle that inflation. I mean, there's a big debate about different types of inflation, whether it's supply driven or because of something like what's happening in Ukraine. But just broadly speaking, inflation has been in the system anyway. This is going to make things worse. The market is trying to judge whether the war in Ukraine makes it more or less likely that central banks will raise interest rates, because obviously commodity prices going higher and ever higher, then that could actually mean that the economic growth that we've been enjoying, or the rebound since the pandemic, could dwindle, and actually central banks won't be able to raise interest rates because the economies around the world might start to struggle. But in this environment, technology stocks tend to struggle, and that's what we've seen at the beginning part of 2022. But with the war in Ukraine, then commodity prices have risen. So oil and gas has soared. We were up above $120 for a barrel of Brent crude oil. And you were seeing a real disparity between the winners and losers. Mostly things are losers. So most equities have been tumbling. You look at markets at the moment. But areas that things like consumer staples, they're the things that you and I would always buy regardless of the economic conditions. Those have been doing quite well. Healthcare, so things like drug manufacturers, they have continued to hold up a bit. They're a little bit more defensive in terms of investments. Things like phone companies tend to be a little bit more defensive. And of course, you've got things like bonds tend to be defensive investments as well. So you can see an environment like we've got now where there's a flight to safety because of what's going on in the Ukraine, then those are the things that historically have tended to do a little bit better. So if you were going to start trying to position your portfolio defensively rather than just going to cash, you might start to look at some of those areas of equity markets. And also you might start to look at things like bonds and gold. Now, what it means is in this environment, those areas that I've started to mention that have struggled, and they also include things like small caps have struggled actually recently, those areas have been those that are usually overlooked by ethical funds. Now, if you recall, there is no ethical sector. If you're looking at funds, investment trusts, ETFs, you just have to go and try and screen them yourself to try and find them. And there are platforms out there, so investment platforms like Interactive Investor that might have some short lists of ethical funds, but it's quite difficult to do. But I've done it for 80/20 investor members, and I've done research pieces where I've gone through and looked at 2,000 odd funds and divide them into ethical and non-ethical. And obviously most funds are non-ethical by very definition of their mandates. And so I've looked at the performance of ethical and non-ethical funds since the beginning of February. So the tensions around Ukraine started to ratchet up at the beginning of February. So now is the beginning of March. And of course, the invasions happened in the last week. So the movements that we've seen in markets have been largely driven by what's going on in Ukraine, but also that macroeconomic backdrop of rising inflation and people concerned that central banks would be hawkish. Now, if you look at all of the funds out there that you can invest in and look at the non-ethical ones, the average return over that month period has been minus 2.75%. I'm looking across all asset classes. I'm just going ethical versus non-ethical, because whatever asset class you might invest in, let's say it's bonds, you can obviously invest in certain companies that you believe are more ethical than others. Conversely, if you look at the ethical funds as a group, then the average return over that month period is minus 3.84%. So it's more than 1% difference, which is quite significant over a 1 month period. Now, if you look at the range of returns over that period, non-ethical funds, there was some funds, or one in particular, that was up 13.5% over that period, whereas the biggest faller of non-ethical funds was down 10.87%. Jumping across to ethical, the biggest faller was 10.34%, but the biggest gainer was 3.84%. That's very different. That's a 10% difference between the biggest non-ethical winner and the biggest ethical winner. So clearly, this environment that we're in, which is one where we had the war in Ukraine and also that macroeconomic backdrop, but it's really the war in Ukraine that's driving things in the last week or so. It is bad for ethical funds. Ethical funds are underperforming. Now, if you go back and listen to past podcasts, or you're an 80/20 investor member, ethical funds have been outperforming non-ethical funds in recent years, and particularly during the pandemic. And the reason that that occurred is because of the types of biases that these funds tend to have. So ethical funds will usually have a bias towards technology stocks, small cap stocks. They'll avoid oil and gas and energy stocks. So basically the dirty stuff they don't get involved in. They don't invest in manufacturers of weapons. They won't invest in things like tobacco. And so those are the very sectors that are performing well in a period of war. So if you look at them, if you go and find the companies that make weapons, they're flying at the moment. You look at things like oil and gas companies, they have tended to hold up better than other types of sectors out there. And during the pandemic, this worked in the favor of ethical funds, because you imagine when the world economy was basically shut, there was no aviation going on, so the shares in airlines were falling. Oil and gas was dropping because commodities were plummeting in value because there was no one buying any of this stuff, because basically economies had ground to a halt. And technology stocks were a safe haven play almost. They were rallying incredibly strongly because we were working from home, and they were producing, well, some of the big companies were producing good profit along the way. So you can see that the biases in ethical funds obviously mean that they really tend to outperform in certain environments. What we've seen is an environment which is a war, unfortunately, in Europe that is causing the areas that ethical funds deliberately avoid. Those are the ones that are starting to outperform. So if you are an ethical investor and you're looking at your portfolio and you think you're starting to lag the market, then that is why. But as an ethical investor, you might want to look at your funds anyway to see what they're investing in. But it doesn't mean that you should necessarily change the way you invest. There's the ebbs and flows. Ethical funds have been outperforming in recent years. They're now in a period of underperformance. So that would always be the case, because ethical funds can't outperform non-ethical funds forever. So it's just the ebbs and flows that you get in markets, but it's been exaggerated by the circumstance. Just as an interesting point, the outperformer or the star performer for ethical funds was a clean energy fund. So you can guess why that's been the case, because obviously with price of energy soaring, then alternative sources of energy are now more attractive given what's going on in Ukraine. And for non-ethical funds, it was actually those that were investing in things like oil and gas, but more importantly, things like precious metals like gold. So some of those miners have been soaring. So the message of this part of the podcast is understand and be in charge of your own ethics about whether you want to try and make money from the situation that's unfolding, or whether you're trying to invest in the long term for the long-term good of the planet or whatever it may be. Then you might want to just stick to your guns. But ESG has a long way to go. But there are those style biases that I talked about. But it just, again, goes to show people, helps them understand how markets work. And it's my take on what's going on in the investment markets, rather than telling people how to profit from a war, which is slightly uncomfortable. I'm highlighting to people ethics and war and showing you how markets are actually moving in response.
Okay, so let's move on to the next part of the podcast. We're going to be talking about risk and volatility. And this came off the back of researching our Grow It. So Damien, what have we got on this?
So I just want to do a brief piece on volatility and risk, because some people think they are the same thing, and they do feel a lot like they are the same, but they are intertwined. So I just want to give people an understanding about volatility and risk. Now, volatility, when we're talking about investments, is the measure of how much the price of an investment goes up and down over time. Now, volatility in itself isn't necessarily a bad thing, but if you imagine a squiggly line, it's always good to, I think, to think about stock markets. If you think of a stock market chart, you see that squiggly line going up and down and bouncing around. That is effectively volatility. So the price moves swinging up and down. Now, if you're a long-term investor, volatility is something that you will just naturally ride. So the price moves go up and down, and the impact as a long-term investor can be reduced because you're holding them for a long time. So you don't really need to care about the intraday swings or even the swings across economic cycles, because obviously you get big booms and big busts in assets. So the level of volatility you get in markets will also vary depending on the asset class that you invest in. So some assets are less volatile than others. Bonds, for example, there's a much lower level of volatility in bonds, usually, not always, because assets do have a tendency for prices to fluctuate suddenly aggressively, as we've seen in recent months. But generally speaking, bonds tend to be less volatile. So if you want to reduce the volatility of a portfolio, you hold different assets and you will hold things that have a slightly lower volatility historically. Now, that is something that is different to risk. So risk is really a reference to the likelihood that the performance of an investment will differ from what you had expected. So usually that means on the downside. So the idea that you might lose money rather than potentially make money. So that is risk. And you can see the two things are interlinked, because if something is incredibly volatile, then the chances of the whipsawing and the movements of the price going up and down, that you may cash in at the point where you are technically in the red, that you've lost money. So there is an increased level of risk that the return that you get might differ from what you thought it would be. Now, as I said, volatility itself isn't a bad thing. And in fact, with increased risk in different asset types, again, for example, shares have a much higher investment risk typically than most bonds. Then with increased investment risk, there is increased potential to make money as well as lose money. Now, there are different types of risk, which I'm going to just run through three of them. Now, one of them is volatility risk, and that is a risk that's associated with you potentially needing to access your money in the short term, and you're forced to sell where the price has fallen sharply, and therefore you make a loss. And now, volatility risk can also cause people to get jittery and cash out if things start to fall in value. So that is a risk that's associated with volatility. There are other types of risk as well, though. There's liquidity risk. So that's associated with not being able to access your money when it's tied up in an investment that you can't necessarily sell or liquidate quickly. A good example is property. So there is a liquidity risk in particular in property. Now, other types of investment like shares are typically very liquid, which means that they are traded on exchanges, or at least the major shares are. There are obviously illiquid shares as well. I mean, you have to go back to what happened with Neil Woodford and the collapse of his funds, where you trade in shares that aren't liquid. But typically the ones that most people will be buying, say on the FTSE 100, are very liquid. There's lots of people buying and selling those shares, so you can actually get access to your money relatively quickly if you chose to cash in, or indeed you wanted to buy some. And of course, another risk that you might get is inflation risk, and that is the risk that inflation erodes the value of your investments over time. So that is typically cash. Now, those three risks I've mentioned, volatility, liquidity, and inflation, it's interesting to mention them because volatility risk is obviously usually associated with things like shares, for example, liquidity risk, things like property. And obviously inflation risk is typically with things like cash, because cash gives a lower return. If you look at the return you get on savings accounts, the interest rates are very low, and inflation at the moment is high by comparison. So we often focus on investment risk. And when we talk about investment risk, people really are thinking about volatility risk, but there are other types of risk as well. Like I said, volatility, liquidity, and inflation. And it's a good reminder that some people always think that because an asset's price might be not very volatile, let's think of property, again, a good example, and you hear the phrase safe as houses, that people think it's a great way to invest money and it's very safe. Although there's a risk that's there, a liquidity risk, which can then come to the fore and cause an entire portfolio of properties to collapse. And it's happened to a number of successful investors over time, and it may be because the banks recall their loans, interest rates rise, whatever it is, and they're unable to liquidate their portfolios quickly enough or at all, and it can cause the whole thing to collapse. So that's the difference between volatility and risk. And of course, as an individual investor, as part of starting to invest, you should ascertain and work out what your attitude to risk is, and really your capacity for loss. So it links in this idea of volatility, how you'd react to it, but also risk. So the fact that a performance of a investment might differ from what you'd expect, and how you would behave around that, and how you would be comfortable with that occurring. And there are a number of tools you can use to work out your appetite or attitude for risk. And we talk about that in Grow It. So make sure you follow us on Instagram, and you can find those tools and use them to make sure that your portfolio that you build is in line with your attitude to risk. And it's one of the most important things that advisors do, is help clients understand their attitude to risk, their capacity for loss, and then recommend a portfolio that suits that. But as I say, if you want to find out more, then do join our Grow It program, which you'll find on Instagram.
Okay, so the final piece of the podcast then, and we're going to bring in Justin to the show, who beavers away diligently behind the scenes doing all sorts of stuff to help keep the lights on at Money to the Masses. And he's a particular expert around the finances and specifically tax. And that actually leads us on to a question that we got from one of our listeners this week. And it was a longer question regarding self-employed people, pensions, but it led on to a specific part of the question, which Justin is going to cover in this week's show. And that's regarding tax when you started a limited company or small business. So Justin, welcome to the show.
Thanks for having me. I think it's probably best to answer this question having looked at the whole thing, just to cover off what is a limited company and more specifically how it differs to a sole trader. Just very quickly for the person that asked the question, but also those out there that don't know. A sole trader is essentially a self-employed person who's the sole owner of a business. If there's more than one person, then that's a partnership. And really what that boils down to is each of the partners in a sole trading business or a partnership, they share the profits and it's treated as their income. That's the main difference. Whereas a limited company is its own legal entity and everything that company does is separate from its owners in terms of the finances and the liabilities. So in short, if you're just starting out, sole traders are very easy to set up. There's very little paperwork to do, but the disadvantages of them is your finances are intrinsically linked and you have unlimited liabilities. So let's say, for example, things went badly and people started to come after you for debts, etc., then you are personally liable for those things. Whereas with a limited company, as I said, you're a separate entity. And so there's advantages to that, i.e. if things do go wrong, then you're not personally liable for those debts. It sits solely with the company. And there are actually a couple of different advantages for limited companies very quickly, apart from the limited liability. The other is that your company name is protected, so you have to have a unique company name when you register it with Companies House. The other part of it, which the question is touching on, is tax efficiencies and certain things around planning for retirement, etc. One thing I will say just quickly is obviously with a limited company, there's a lot more legal responsibilities. And I would recommend anyone out there that's looking at setting up a limited company, the first thing I would suggest is get yourself an accountant, because the tax rules around limited companies have changed so regularly that they will help you from making any mistakes and help you set things up properly. So let's look at the question more specifically about taxation around limited companies. So the first thing to point out is that limited companies pay corporation tax on profits. So if you don't make any profits, you don't pay any corporation tax. As a owner of a limited company business, then you also can be paid a salary and you can also claim dividends and you will pay tax on those. As a sole trader, all your income is treated as income tax. You don't get some of the tax savings that I'm just about to explain to you, because limited companies, the way that the taxation works, they're a lot kinder for higher tax rate payers. And I'm going to just set you out a couple of examples just to so people know very quickly. So if you was a sole trader, and I'm going to assume you have no costs, etc., and you earned £60,000 in the 21-22 tax year, you will effectively take home somewhere in the region of £44,500. That's because all of that profit you've got just been taxed as income. So that would be roughly around 26%. An effective tax rate. If you are a limited company, this is where the taxation is different and can be more beneficial, is that you can change how you're effectively paid. So you could pay yourself £60,000, but £20,000 of that could be a salary and £40,000 of that could be a dividend. What we see there, if we was to do that scenario, is actually your effective tax rate becomes nearer 13.5%. So you would take home out of that £60,000 almost £52,000. So in the example I've just given you, you'd actually be £7,500 better off by taking your income as a limited company, because you can pay yourself as a salary and as dividends, because dividends are taxed at a different rate to income. So the tax rate on dividends goes from 7.5% up to 38.1%. I won't go through all the bands because you can see that on the Money to the Masses website. And to give you the context, if you was employed and you wanted to take home a net income of £52,000, as per my example with the limited company director who was paying themselves salary and dividends, for you to take home the same amount of money, you would have to earn a salary of £75,000. So again, it shows you the difference as a director of a limited company, some of the tax advantages, how it can be slightly more beneficial. One of the things that I want to point out is there has been in the past people that would make themselves limited companies so they can pay themselves salary and they can take a dividend. Be very careful with this, because this works very well if you're a freelancer and you have multiple clients. But if you use it as a way to almost work exclusively for a company, but you get paid as a limited company and you structure your payments as dividends and salary, then you could fall foul of the IR35 rules, where you're engaging as a worker on a self-employed basis, but you're effectively disguising your employment status. So that's a word of warning on that. Limited companies, you should really only be looking to set them up if you're looking to grow your company over time, limit your liabilities personally, and you're not really trying to kind of avoid tax, let's be frank. The one last thing I'll touch on before I finish is there are differences as well on pension contributions for limited companies. So as an employee, you obviously can make your pension contributions and there are tax benefits of that. But if you own a company and you own a limited company and you're a director, if you pay yourself in salary and dividends, your salary might be quite low, maybe £12,000, so you don't have to pay too much tax on it, then that causes problems because your pension tax relief limit will be quite low. One of the things that you can do as a company director of a limited company is make the pension contribution straight from your company as an employer contribution. So effectively, the company pays money into your pension. I won't go into the details of that. More of that can be found on Money to the Masses website. But essentially, just to cover off that question, there are tax advantages and differences between limited companies and sole traders. You can structure your income differently if you're a director of a company. But again, what I would say is make sure you're doing it for the right reasons. Make sure that you get yourself a good accountant if you're setting up a limited company, because there is a lot of paperwork and legal requirements that you have to do, and make sure that you're not doing it for purposes of just trying to hide your employment for a company.
Interesting stuff. Thanks so much for that, Justin. And so let's bring Damien back then to finish off this week's podcast. We're done, aren't we? We just need to go through the usual stuff. Don't forget, Grow It is coming up. Get onto Instagram. Follow that program if you can. We've got the Facebook group as usual, facebook.com/groups/money to the masses if you want to get involved in asking any questions or speaking to the hive mind that is the Money to the Masses community. And of course, you can contact Damien as well. It's damien@moneytothemasses.com if you've got any questions for him.
And as ever, we've left it to the end of the show rather than at the start of the show. Please leave a review for the podcast. We've done 500 episodes. If that's not worth a positive 5-star review on iTunes or whatever podcast app that you use, then I don't know whatever will be. So thanks to everybody listening to the show, and until next time.
Until next time.